You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Mike Woodfield, an exceptional guest and real estate investor out of Texas. Please help me to welcome our guest and Please help me to welcome our guest. How are you, Mike?
Good to talk to you, Adam.
Thanks so much for being with us today, and I appreciate you taking the time.
Absolutely.
So I would like to start with the beginning. Like we were just chatting about, you're starting on multifamily. So what was the beginning for you? How was the beginning for you on the multifamily business?
So right after school, I've always been an entrepreneur. I started a company. It was actually a company that was failing, and I went in with two business partners, and we bought a failing company, much like we'll buy sometimes distressed assets. This was a distressed company, and we went in and managed it better, operated it better, and I decided to exit and got my first check out of college. So I got the taste for entrepreneurship and the potential upside of it. At the same time, Glenn Gonzalez, who is my business partner now, he was starting his own syndication company, and he said, "Well, you're exiting this company. It may be a good time for you to come over here, and you're obviously an entrepreneur. That I'm an entrepreneur. Let's try and do business together." And he had all these years of experience in operating apartments. And, as many people come to learn that are good at operating businesses, they can learn the real estate and become good at operating, those as a business. And so he trained me over the course of about 4 years. He helped me a lot, taught me all the asset management things I needed to know. And I dove just completely both feet into the industry and became a sponge and learned as much as I could about the finance side and the underwriting side and really acquisition side of the business, and spent a lot of time learning the whole picture. I got my CPM designation from the Institute of Real Estate Management, so I even understood the property management side of the business, so I would understand and have a good knowledge going into buying properties. So it really all started from just my entrepreneurial spirit and wanting to be my own guy that makes and dictates when I work, and also to capture the upside of my hard work.
So, this is one of the lessons is the advantages of the partnership. But back then, what was your advantage, and what was the pros and cons for you to start actual early partnership? And looking for to strengthen your market with someone else. So what was the pros and cons back then?
Yeah, back then, there was a lot of upside for me. Glenn had all the knowledge in the multifamily industry. And I looked at it as and he can really mentor me and teach me this stuff. And being in the war room with him every day, I'm going to learn. Also, the connections and relationships he had were so deep that those relationships have now become my relationships. And obviously I had to, be likable and smart and try my best. I couldn't, inherit them or whatever. But, the advantage for me was that he was in the industry and he had his foot in the door with brokers and different things, which takes years to do. It just does. The advantage for him was I was hungry and was willing to work really hard. So, I took a lot of work off his plate that he was used to doing himself. And I freed him up to focus on building the business. And in the early years of that relationship, I worked a lot of hours and did a lot of the asset management and things like that. And so he was freed up to go do more acquisitions. So the trade-off for him was I give my time and impart knowledge, and also get freed up to go do then more deals. So it worked out really well.
Good. It's been on the partnership for more than 8 years, I think.
Yes. Yeah.
Okay. So first question will be, what is your current target market, and how many units under management so far?
Got it. Our current target markets, I mean, anywhere within Texas, excluding a few markets. We tend to focus on the triangle of Texas, but we live in Austin, so in and around Austin, Texas, the suburbs are high on our priority. Central Texas, and then we'll look in DFW. We look in San Antonio. Just closed a 120 unit deal down south of San Antonio, and we'll look around there. And then we look in other major markets like Salt Lake City, Phoenix, Atlanta, North Carolina, like up in Charlotte and such. So,
okay. And how many units under management so far?
Right now to date, we have about 1,500 units, but in the last 8 years, probably a total of 5,500 units that we bought and sold. But currently we're managing and have under our portfolio about 1,500.
Okay. So your approach is mainly on close management, not on remotely management style, because you know your core team from property management. Are you dealing with the property managers, or you're managing the property by yourself?
We self-manage very few things. We usually third-party manage our projects. Our process there that we've developed has been, we find the local expert in whatever market we're in. So, for example, we're looking also in Nashville and kind of Lexington, Kentucky. We're looking in Louisville, Kentucky as well. We found a really, really good management company over in that area. And we're kind of growing with that management company in that area. And the great news is as we grow, they grow. And so they're incentivized to really keep us happy, because we gave them our biggest project over there, 258 unit deal that we closed. And, they watch it like a hawk. So if you can find a management company that's invested in your project being successful because they want more business from you, that's ideal. Otherwise, you have to rely on relationships and experience over the past. So we use another third-party management company that manages our Dallas stuff and our San Antonio stuff. And they're at the corporate level, we know the folks there really well. So it's just easy for us to give them another project because we've had so many projects that they've done and done well. So, but if I find a good deal in like some obscure market, I'll try and find a local management company.
Okay. So this is the first point of the question, which is actual property management. But when you're looking for the deals, what is your criteria, profit-wise? The target IRR, cap rate, especially I'm asking this question because of the new inflation, especially on this market, the inflation, the appreciation, the new market deals. The new bank interest. It's all of them is affecting the actual price and the cap rate. So what is your current criteria within the market inflated?
It's a great question. You're going to see a lot of contracts that are going to be busted because if you went under contract 90 days ago, I mean, it's just not the same. It's not the same market anymore. And the capital markets have shifted just so far. That all being said, our criteria for our underwriting has changed. We're stress testing deals with a much higher interest rate. We're looking at somewhere between 4.6 and 5%.
Interest rate. Okay.
On an interest rate.
Yeah.
On a bridge loan, you're looking higher. You're looking around 6.25 to 6%. If you're using SOFR as your baseline, and SOFR plus like 150 basis points or whatever it is, 7
to 8, I think, %.
Yeah. You're looking closer to 6.5%.
Hmm.
So, gone are the days of, those really, really awesome floating interest rates that everybody was trying to do because interest rates are so low, and now they're paying the price of those floaters. Because people, it's so funny when you think about what we were facing. I think if we were to ask anybody today, they would answer honestly saying, I knew that the interest rates were going to go back up. There was no way that was sustainable. I shouldn't have done a floating interest rates. I should have locked in at a low interest rate, knowing that rates were going to go up, because what people were trying to avoid was the heavy yield maintenance penalties of selling a deal, So they took a risk, and they're like, man, if interest rates hold this low for another 3 years, I can exit on a floater and have very minimal penalties on the exit. But what they found was that they just got killed, and it's just tough business. Whereas if you were to lock in, like we locked in on a 10-year term with Fannie Mae at a 3.3% interest rate.
That's good.
Yeah. And it's full
10
term,
years.
10 years, full term IO, 10 years interest only. And we locked that in. We closed, I rate locked about 120 days ago. I paid a $350,000 fee for that. But it was the best move I probably made in my career to date, because, rates skyrocketed literally weeks after we closed. So thank goodness, we did that. But, to go back to your original question, we're stress testing deals. Our criteria is still, we're looking for, and Glenn and I always buy on cash flow. We always want to have, 6 to 7% cash on cash as a minimum going into a deal, because we know that, times can change and that cash on cash can drop, but we're stable to pay our bills and have stay power. So we seldom will look at an appreciation play anymore. Meaning you buy at a, whatever cap, 3 cap, and, you maybe sell it at a 3.5 cap a year or two later, or you sell it like a 2.9 cap. The cap rate compression is kind of gone in my mind.
So still now there's deals with 3 caps on Texas?
Yeah. Oh yeah. Yeah. Deals are trading, at insane prices right now.
So regarding your criteria, are you based on B buildings, C buildings, and also what kind of strategy is that, buy and hold or force appreciation?
We're buy and hold guys, and we have been the past 2 years. It's so hard to find really, really good deals. And we try to only buy really good deals. We try not to just buy, it could work if we hit everything perfectly. So we're buying fewer deals than we used to, quite frankly. But, we're looking somewhere in like the B- to A- range. Anywhere from 1988 to 2001 built product, that we can still go in and increase the value there, maybe renovate units.
But A-, this for me is interesting, because usually we go to a C or B buildings, but you're saying A-.
Yeah, those C product, too much headache for me. We've done that. I think that everybody goes through an evolution in their real estate investing, and it's very, typical for people to get in and they buy a D product or a C product building, and they try and turn it into a C+ or a B- product. It's getting harder to find projects like that. A lot of those have turned. So the natural progression as you have more capital and liquidity and you have more investor dollars to invest is you buy nicer stuff that's a little less of a headache and you still try and create value. We just bought something that was 2015 built, and the value that we created there wasn't in renovating units. We brought in a new management company. We came in with a really good asset management plan. We're tracking the rents, and we're increasing the renewals at a 15% rate. and we're increasing the new leases at a 25% increase. Now,
so the net operation income, enhancing the expenses ratio, and focusing on net operation income.
Yeah, I mean, of course, you look at the expenses and you try and keep those in budget. I mean, you know, you give the property management company a budget and say, hey, this is what you got to do. And if they sign off on it, they better do it. But I focus on the income. The other thing we did is we brought cable and internet to the project. They had some, you know, one of those third tier, second tier internet companies. Yeah. You know what I'm talking about.
Yeah.
We brought in Spectrum and signed a contract with them. And, you know, we're selling it to them at a profit. And everybody loves it because it's cheaper than what they were paying before. We weren't capturing any of the gain from that. And everybody, we've signed up almost 85% of the tenants at this point. And we owned it 2 months. So yeah, we're going to get to 100% of the people paying us that. And, you know, we bumped our NOI up about $10,000 a month just from that.
Wow.
So, you know, talk about value add, you know, and this is a 2015 built building. I mean, these are great.
It's an A product, correct?
It's an A product. Yeah.
Oh, wow.
But you can still create a value in an A product. You can. There's still operators that leave meat on the bone. In other income, they didn't buy washers and dryers, and there's 120 sets of washers and dryers that can be bought, and we're leasing them out for $65 a month. So you can do the ROI on 65 times 12 divided by $1,300. It's like a 50% ROI. That's a good investment, right?
Yeah, it is. It is. Yeah. Especially it's a different mindset. Like always, me personally, to be honest, always B minus, C plus, to turn it over to B. It's headache, and I'm gonna get to the point because your market is too hot. Appreciated, as you mentioned, the cap rate is low, no good deals. It's hard to find, but this approach is making more sense because eventually it's not about following everyone. It's what is making sense, which is I need to make the net operation income. I don't have to hustle, and it makes sense, to be honest. Yeah.
You find the value, and you go to where you can create value. I agree with you. You can follow the same old what's worked for everybody else, or you can go and create something yourself. And we found a good niche, to be frank with you, and we're focusing more on operationally, how are we stronger than everyone, and how do we asset manage better than everyone, rather than throwing money at everything. It's like, how do you still get deals done in a market like this? You spend less money on making the property look really nice. You still spend money on what's important, but you really sharpen your operations, and you really make sure you're paying attention to these projects. That's how you create the value. Okay. So, that's what we've done here recently, and it's worked out pretty well for us.
So what was that like? I'm not going to focus on the last 8 years. On the last 1 year, what was the challenges on the Texas market?
There's just a lot of competition. People love Texas. They it's a business friendly state. People, whether they admit it or not, like the government and the laws that Texans abide by. People like that Texas pride is a real thing. Whereas, there's not too many people that have like, I don't know. I'm just going to pick a state so no one get mad here, but no one really has like, Minnesota pride necessarily. You don't see people wearing Minnesota shirts like with outline. And Texas, Texas is its own thing, but also the economy here just keeps getting stronger because there's so many huge cities. I mean, Houston is, I think, the third largest city in America.
It is.
Dallas is top 10. San Antonio, I think, is 7. And Austin, I think, just creeped into the top 10. Yeah. And Austin is just growing. And we saw 30% rental growth last year.
Appreciation too. It was appreciated like crazy. It was the last 3-4 years.
Yeah. And, in my mind, what's creating that obviously is Tesla's moved here. Samsung just announced their $17 billion manufacturing plant in Taylor, which we happen to have a new development deal that we bought or that we're building there. So that was good luck.
I think the market has all of the strong fundamentals.
It does. It does. It's a great market. And just to be frank, California is losing people and we're gaining them. And, if you sell your home in California, that's a 2-bedroom, 2-bath for $1.5 million. And you move to Texas and you get a 5-bedroom, 5-bath.
No, you can get a building.
Yeah, exactly. Well, my point is that eventually, we can't keep up with the demand here. So what you're really seeing is you're going to see home values and rental rates that of LA in Austin in not too long, I don't think. So,
I think COVID was one of the major factors here because the people are moving from northern states and the west side and going to the east side, especially the south side.
Yeah.
So I'm not sure if this is good for you guys or bad, but I think that, as you mentioned, it was too free. Like the competition is crazy right now because of this.
Yeah. Well, and there's a lot of people coming in from the outside trying to get in. We've been here for well over a decade. We know all the players. We know a lot of people in the market. We know the brokers. So we have a leg up from a standpoint of finding a deal still. And, all of the current developments that we have underway have come through relationships, in a roundabout way, dealing with the landowner directly and making them a partner in the deal, and getting a good price for the land. These are all things that, you have to do to survive in a market like this. Otherwise, you're looking at very low leverage, raising a bunch of money and coming in and trying to take down a deal to make it make sense or to, make sure you're not putting everybody's money at risk. Because
100%.
And you can't even get the leverage. You used to be able to get 75, 76%. And now you're looking at closer to 67% in some of these markets. So it makes it tough.
Yeah, it is. And you have to have cash aligned with more equity partners. Yeah.
Yep.
Yeah, it's a tough game right now. And which is bringing me to the next question is, what is your, do you have any a backup plan to move to other markets like Tennessee, Alabama, where the price of per door is less? So you can have more doors, or the focus only is in your local market where you have a strength with a team?
So that's funny you say that. Like I said, we bought 258 units in Kentucky. We made best and final on 216 units in Lexington, which is just close by Louisville. It's where the Kentucky Derby's held, I believe. Hopefully I'm right on that. But, we are still finding that, there's some areas in the world where you can buy deals that aren't so insanely high that you can't make sense of them. You can buy it, $60,000, $70,000 a door, which used to be super, super high in Dallas, for example. When I was looking at deals we were selling in 2018, we were selling them for $65,000 a unit.
180 now, I think 170, 180 per door.
Yeah, we were thinking these people are crazy. Yeah, that's what we were thinking about. How are they making this work? How are they making a budget pencil? And we were thinking, man, we're barely on some of the C product, we're barely cash flowing with the delinquency issues and stuff that you face on that stuff. And they came in and they paid double what we paid. And, they're selling it for double what they paid. So, I mean,
I'm coming from the same market, by the way. Toronto is the cap rate is 2.2.
Yeah, Toronto's tough. Yeah, I'm sure. Yeah. I'm sure. Toronto's an interesting market. But we struggle with, those same things in Austin. It's pushed us a little outside of, Austin, for example. We won't own one deal in the zip code of Austin. We own a deal in Taylor. We own 2 in Leander. We own 1 in Liberty Hill. and one in, three in Leander, excuse me. So, we're looking at the suburbs and trying to create the value through development. So, the replacement cost of a unit right now is just cheaper, right? If I'm to build a multifamily project, I can build it for cheaper than it costs to buy them. So would I rather have 2022 brand spanking new units that takes me a little time and energy, but I'm at 200,000 or 185,000 a unit all in, where that same product brand new, leased up is 275,000 a unit? Yeah. I'd rather go create that value and capitalize on it. So that's
the return is insane on the development part. It's not going to be 18-20%. It's going to be 50% or more.
Right. Yeah. I mean, your multiples on new development are much higher. I mean, and a multiple on a value add deal, or like a coupon clipping deal, maybe a core product is, you're looking at like over a 5-year period, maybe like a 2x, maybe like a 2.3x multiple
maximum in your market now.
Yeah, that's maximum.
The multiplier, you mean the equity multiplier?
Yeah, equity multiplier, but multiple on a new built product could be like 4 or a 4.5. So you have to be more patient. You don't see cash flow in the beginning, but if you find somebody that knows what they're doing and they're in a good market, you should see that money quadruple over the course of a few years. So
100%. So if we're talking about your latest deal, if we can break it down, what was the purchase price, number of unit, especially on this crazy market, especially the cap rate? I'm really interested to know how you bought your last deal with the new market inflation prices. So when was that, your latest deal?
So we closed a 120 unit deal in Floresville, Texas. It's a market that's southwest of San Antonio. It's a nice little market that's growing. And, we financed that we closed that 3 months ago. So it was really before the huge interest rate hikes, and we did pretty well there. But, still it was getting scary back then. We kind of saw what was coming. So like, we better close and do it quick. So we did well. But yeah, we bought that at a good price per door.
How much was the price per door?
I can't tell you that, because Texas is a non-disclosure state, and the state might be listening. They're going to know my value, and then they're going to jack my taxes up. So
Don't say.
Don't say. We can talk offline.
No worries.
But we got it for a good price per door.
Okay.
And we've increased the value to a point where I'm like, man, this was a good deal. I'm glad we did it. The tricky part is we plan to refinance in 2.5 years from now. Okay. So the question is, where are interest rates going to be then? Right. Correct. We have enough cushion in there. I think we underwrote at about an 8 or 9% cash on cash at stabilization. So we have some room there, for a higher interest rate, to where we can still cash flow at a good rate for our investors. But, if we refinance at a 5% interest rate, that kind of hurts, right? It hurts the cash flow, what we projected, but it is what it is real estate. It's hard to predict all those things.
So what was the upside of this deal? Like, what was the potential on this deal?
The upside was in the management and operations. It was in bringing internet and cable to the property. It was in the washers and dryers. It was in the fact that they hadn't been aggressive with raising rents or on other income. Frankly, they weren't charging enough for utilities. So we captured a lot of that, and we've done that already. That was the upside. This deal really was like one of those deals that you put in your portfolio and you're like, man, I'm just going to hold that for 10, 15 years. It cash flows. It has a good occupancy. It's not a big headache. It's well managed. It looks nice. It was built well. So it's not always about flipping that property quick and making a quick dollar. So at some point you got to think of, how many good projects can I find, before I find a bad one, that hurts. It's like, hold on to the good ones, and what I mean by that, the really good ones that cash flow really well, hold on to those projects, because inevitably, I mean, if you're just looking at time, things go up, they trade at a higher price per door than they did before. So if it's cash flowing well, keep it. And that's my philosophy. Of course, people are like, nah, turn and burn. You need to buy 30 projects a year and, completely turn your portfolio, after 3 years, and man,
Over leverage it.
Yeah, that's a lot of headache.
Yeah, it is. It is. It is.
It's a lot of headache. So I don't know. We've done that. We've, if I could show you my wall out here, we hang up a picture of all of our deals, and we got 40 pictures on the wall, and a lot of them are what you're talking about, that C plus asset that, we held.
Even D. Yeah. Okay.
Yeah.
Even
D.
D.
Yeah. Even D. We bought stuff that had grass in the parking lot and was boarded up, and, it was a total, there wasn't even a re-tenant. There was no tenants. It was 100% unoccupied, and,
wow.
We've dealt with stuff like that before.
So it was 100% you financed it for cash?
No, a bank owned it. And we actually got them to do, to carry a note back on the property. And then we raised the rest of the money to come in and do the rehab. Okay. So, it was a good deal. And we executed and sold and made money. But, I've gotten to a point where I'd rather just find good cash flowing deals that you'll see some appreciation, but that we'll be able to hold and cash flow and return people money. And the reason why I got here is I found that with most investors, they can tell you like, hey man, I want to see a 20% IRR, else I'm not working with you. Or they may say, I really just like the quick flips of cash, but really what they like is getting a check in the mail every quarter. That's really what investors like. I know that a lot of, and there may be some private equity groups that it's turn and burn, or there may be some family offices. I'm talking about your doctor in Iowa. I'm talking about your attorney in Atlanta. The guys that maybe invest in a syndication, they like seeing the cash flow come in. And so we've tried to find assets where we can show them that we can do that. And so that's been our focus. And ever since we made that our focus, my life has been very, very good. As far as stress levels, I've been able to maintain
100%.
Yeah. So,
yeah. So I think you open a can of worm here, which is basically raising capital. How was your initial steps? You as an individual on the game for the raising capital, especially with accredited investors, qualified investors, 506B, 506C. How you make your deal investor friendly, basically?
Depends on the deal that we do, whether it's 506B or 506C. We've done both. I would prefer to work with a few people that are accredited. It's less folks that you have to chat with and get org docs signed and PPMs signed. And, but on the other hand, we've had success raising money from non-accredited investors that we've had 40 people in one deal. And, it's just 40 K1s you have to deal with, and, 40 signatures and, 40 people you have to tell, hey, we're selling the project. And, it's just a more pleasant process from a syndicator's perspective. And I'm talking like, at this point, Glenn and I are a little bit more picky about who we do business with because we have that option. It's taken a lot of years to get to that point. In the beginning, it's like, man, if you come on in, let's go.
We're open.
We're open for business. Please come, But now we've built up a reputation and have enough folks that have invested with us on multiple deals that it's like, okay, I want your next deal. Make sure you save a spot for me, right? And so we have a little bit more option to pick and choose who we do business with. So our first option would be to find one person to write the whole check. And then the next option,
Makes sense. Yeah.
If we can't do that, then, up to 5 is kind of where we like to be within. Our last deal, I think we had 10. So
how big it was?
It was a $6.5 million raise.
Okay.
So, still, between $250,000 and $1 million checks, somewhere in that range is
So it was almost, I think, $12 million deal with the renovation, or more, 15. I think more. 15.
That deal?
Yeah, 30%.
It was
so $16 million, I think.
It was a $16-17 million deal.
Yeah. Okay.
So anyways,
okay. Yeah. My next question will be how you manage to have your everything, your marketing strategy in place for attracting raising capital. Especially, you said you became more picky. So is it about always referral, or you still having this on the side, that marketing for yourself and your deals and your projects?
We use a software that kind of acts as a Rolodex for all of our investors. And, we try and attract people to our website, and, we'll send out invitations to sign up on our portal. And basically what happens is when they sign up on that, whenever we have a deal come up, we'll send out an offering memorandum through that portal. And, they'll get it, and they can reserve investments at that point, in that deal. So we've had some good success doing that, and we don't spend a lot of dollars on marketing, for good or worse, I guess. We haven't had a project we haven't been able to raise the full amount of money. We've been able to be successful there. So I guess Glenn and I are like, well, maybe we don't necessarily need to spend a bunch more money on marketing yet. I think the bigger issue is the deal flow. How do you find good deals more frequently?
100%.
Because you don't really need capital if you don't have deals. So I would say spending your money more on finding good deals to buy, whether that means that you have cold callers trying to find off-market transactions, or you have an underwriting team that's just turning deals over and over and over again in your underwriting model. Once you find a lot of good deals, it's a good thing to where you don't have the capital. You're like, man, we got to find more capital. We have too many deals. That's unusual in today's market. It's usually
in your market.
Yeah.
Your market is tough.
Yeah. We're in a bull market. So we have been. So, usually it's the other way around. You've got people that says, find me a good project, and you don't have the projects to bring. So,
it's a trade.
It's a trade. Yeah. It's tough. So if you can make it a habit to find good deals, and you can, look at a lot of transactions and weed through them to find the one or two, or 3 or 4 a year that are really good, you'll probably have repeat customers coming back writing bigger checks the next time, and then you find yourself, you're like, man, I've got 10 investors I go to every deal, and they always fund it,
So you always go with syndication, not a fund.
Yeah, no, we don't have a fund.
Okay. So I think the next question will be the fun question, which is, who is your influential mentor in your real estate career so far?
Glenn.
Okay.
Yeah, for sure. I mean, by far, if I said anybody else, I'd just be lying. That guy has taught me more than I could have ever asked for. He's such a good person, in addition to being very, very knowledgeable and one of the leading experts in what we do. So just enjoyable to be around, in addition to just being super smart. So him by far.
Great. My last question will be, What you say about your superpower strengths?
My superpower strengths.
Yeah.
I would say probably my strong suits are, and I, when you ask these types of questions, I always am like, man, am I sounding arrogant when I say this? But I've never met a stranger. I can make friends with people pretty quickly. And I think that that's a superpower that a lot of people lack, is just being likable. And you need to be likable. People don't have to do deals with you, and they don't have to take your business. We've been in this bull market. People can tell you to, go look somewhere else. I don't have to deal with you. And so if people like doing business with you, you should see some more success. The other thing I have is a desire to learn. I don't have such a big ego that I'm not willing to ask questions. I had a guy sitting in my office here an hour ago, and he was a debt fund manager, and I haven't dealt with debt funds ever before. I mean, I know what they are and their function and what their goal is, but tell me the gotchas with debt funds. Tell me why my underwriting might raise some red flags with a debt fund, but it doesn't with a traditional bank, or lender, and just asking questions. So the other thing is I'm able to be teachable. I try to keep my ego at bay, and just try to learn and absorb as much as I can. So, and then my last superhero or human thing is probably, I value relationships above money. I truly do. I think loyalty to people and friendships and relationships are far more important than money. I think money is a byproduct of hard work and relationships in business often, and you do reap the fruits of your labor. But to me, would I rather have a friend or money at the end of the day? I'd rather have a good friend. I think that relationships at the end of the day are what fulfill you, and where real value is in life. So I would say that those are kind of,
especially in this business, I think it's based on trust and relationship and networking, and you said, as you said, you have to be a people guy.
Yeah.
This is the base of this business, to be honest, where you can find deals, you can have relation with realtors and property managers and so on. So
so
that's and gain trust of your investors too, which is the main goal. Not intentionally, but this is your charisma and your personality.
Right. Yeah. I mean, you have to initially attract them somehow. I mean, it's just like finding a soulmate or someone to date.
It's a marriage.
You've got to attract them first. They're not just gonna wander in for some reason to so you've got to be likable, and then also you've got to have integrity to keep them there, because if you don't have integrity and you lie to them, they're never going to invest with you again.
100%.
So one of the best compliments I can get is a repeat investor. Someone's like, you know what, you've done right by me, and you were honest with me. Maybe things don't go perfect, because guess what? Things don't go perfect in anything, but having someone come back and reinvest because they're like, I like you and you always shot me straight. That's a great compliment. So
I think the transparency also always good in the business is, and the follow-up, like the approach of having everything every 3 months, quarterly, so we can follow up what's happening and be transparent with your investor is a really good approach in our business as a syndicator. So I agree with you 100%.
Totally.
My last question really is, how the people can follow your success?
That's, I have a LinkedIn page. Okay. I do have social media and stuff like an Instagram or Facebook, but I don't ever post anything about work. You only see pictures of my kids, and that's really what I care about anyway. But
it's a private, even anyway. I remember it was a private account.
Yeah, and you can follow me. I think it's at Mike F. Woodfield.
Yes.
on Instagram, or Mike Woodfield on Facebook. And then, and I'll happily add you if you want to. I'll follow you back if you want to add me.
Yeah.
Not my goal to gain Instagram followers on this podcast, but if that's cool. And then if you ever want to, grab lunch, or if you're in the Austin area, you can email me at mike@obsidiancapitalco.com, and I'd gladly have you come check out our office, or come say hi. So
it's a great place to have lunch. But
yeah.
I think it's going to be on your treat.
What was that?
It's going to be in your treat.
Oh yeah, of course. Of course. Absolutely. If you're flying from Toronto to see me, then I'll buy you lunch.
100%. 100%. Yeah. Okay. Thanks a lot for being with us today. It was fun, and we're happy to bring you again to the show. Thanks a lot.
Thank you so much. I appreciate it.
Thank you.